Mortgage rates have been sliding for 3 weeks now, and while we might be celebrating, we know historically these dips don't last long. So here's the real question. Is this the bottom, or is the Fed about to push them even lower? This morning's CPI report, a brand new Fed nomination, and a slowing jobs market are all in play right now. And the headlines, well, they're getting noisy. But before you decide to wait for rates to drop even further, I want to break down what's really moving the market, what the Fed can and can't control, and how these moves actually impact the mortgage rate that you pay. Let's also talk about what happens when rates do hit 6%. I mean, what can you expect to see as a buyer in that market? Because the truth is, the smartest buyers aren't just watching the news. They're reading the signals and starting to take action. We see that with increasing mortgage purchase application data and this month's jump in Fannie Mae's buyer sentiment survey. Let's start with today's CPI, or Consumer Price Index report, which came out at 6:30 a.m. Mountain Time. And yes, I was ready and watching. While the CPI is not the market mover that the jobs report is, this one is critical, especially in today's tariff-curious market. Headline inflation came in as expected, with month-over-month up 0.2% and the year-over-year the same as last month. Core month-over-month was up 0.3%, with the year-over-year up 0.2% to 3.1% year-over-year. And although year-over-year core, as well as core products, have been on an increasing trend for the last 3 months, it didn't jump considerably. And with tariffs now pushed out yet another 90 days, the markets are looking at this and somewhat ignoring the increase. They're rallying immediately, but they did give back about half of those gains within an hour. As a general rule, this report matters because ultimately higher inflation tends to lead to a bond sell-off, and that gives us higher mortgage rates. Lower inflation leads to a bond rally, even if it's short, and that pushes yields towards a technical floor of the 10-year Treasury being at 4.2% and rates lower. Either way, this number is part of a bigger story, the Fed's fight between keeping inflation in check and avoiding a deeper slowdown in jobs in the economy. It's important to note that we've already seen mortgage rates drop about 0.375% since July 15th, from 6.875% to 6.5%, thanks in large part to the weaker jobs data. Now, on a $400,000 loan amount, that's already a $100 a month savings, and that's even before we get to the Fed's next move. So what is exactly moving the Fed? Well, a lot lately, actually. First off is the massive miss in the BLS jobs reporting. August 1st jobs report was brutal, with 258,000 jobs in revisions going back to May and June, and a disappointing 73,000 jobs created in July. This resulted in a weak 35,000 new jobs created on average over the last 3 months. That's the weakest stretch we've seen since the pandemic, and the biggest revisions going back to 1968. The second that number hit, the markets recalculated, dropping the 30-year fixed mortgage rate by 18 bips, as well as the probability of a Fed rate cut in September from 39%, which is what it was after the Fed meeting, to 91% on August 1st. Then came the White House moves. Adriana Kugler, one of the Fed governors, resigned. In her place, President Trump nominated Stephen Moran, current chair of the Council of Economic Advisors, to fill that seat temporarily through January 2026, giving him the time he needs to nominate the next Fed chair and putting another Powell dissent on the board. And Moran is known to be a strong supporter of the administration and for lower rates. If he's confirmed by the Senate when they return on September 2nd, he will be a voting member at the September 17th Fed meeting. Why does that matter? Well, Moran is known for focusing on employment over inflation, and that can lead towards cutting rates sooner to support jobs. As soon as Moran was nominated, JP Morgan immediately moved their forecast for the first cut from December, which is where they had it, to September. And now they see 3 more quarter-point cuts after the September cut and before the Fed pauses. This is a big shift, and it's all about the labor market showing cracks. Fans of lower rates are watching, and they're cheering on these shifts in the Fed regime. But this is where I want to pause, and I want to highlight a common misconception. The Fed funds rate controls short-term borrowing. Think credit cards and HELOCs and car loans. The 30-year mortgage rate, well, they follow the 10-year Treasury yield. Plus, something called the mortgage rate spread. Basically, that's the risk premium that investors demand to lock up their money longer and have it impacted by inflation and uncertainty. Now, the administration has outwardly targeted a Fed rate of 1% and a 10-year Treasury of 3.9%. With our current mortgage spread of 2.2%, this would give us a 30-year fixed rate of 6.1%. But the administration honestly doesn't control either. They can influence the Fed with the recent changes of the board, and they can influence the 10-year Treasury with changes in fiscal policy like tariffs, but the 10-year Treasury is primarily moved by economic data like inflation, as well as labor and the strength of the economy. And the mortgage spread, well, that's moved by uncertainty in the financial markets. It's also important to note that investors play the market, making bets on how the data will show up or when the Fed will start cutting rates. Their expectations often price in moves before they even happen. So to make things even more interesting or confusing, depending on how you look at it, while economic shifts, political policy, and Fed announcements can move the rates, investor trades on those moves add volatility. As an example, after today's tariff-muted CPI report, markets jumped from an 84% chance of a September rate cut back up to 94%, and a 66% chance of a second cut in October, and a 57% chance of 3 cuts before the end of 2025. This will inch rates better today, far in front of the actual Fed moves and why rates sometimes reverse on actual Fed cuts. So if it's the data and the expectation of the data that moves the markets, it's important to know what exactly is happening between now and the Fed's September meeting that can both influence the market and the Fed. Well, August 21st through 23rd is the Jackson Hole Symposium. This is where the Fed gives its big picture read on inflation and jobs. Moran won't be on the board yet, but with 3 voting members and 2 non-voting members already dissenting, it will be important to hear what Fed Chair Powell says in his often short speech at the end of the meeting. On August 29th is the release of the PCE inflation report. And while we'll already have seen the CPI report, this version is the Fed preferred measure of inflation and is more heavily weighted on healthcare and less on housing. Then, on September 5th, we have the August jobs report and unemployment rate. Remember, unemployment moved from 4.1 to 4.2%. So additional moves and/or another soft jobs report will secure a Fed rate cut as labor continues to struggle. On September 11th, then there's the August CPI report, and then the big show on September 17th as the Fed meets to decide whether or not to cut, and of course, by how much. Every one of these could shift the market. Remember, investors react before the Fed actually moves. Today, we are in a unique moment. Rates are lower than they've been in 10 months. Inventory, while dropping slightly, is still higher than we've seen in years, with price reductions on 42% of the homes nationwide per Altos Research and 60% of Denver Metro listings per DMAR. Inflation is trending up slightly due to tariffs, but still low compared to recent highs, and the labor market is softening, but not yet collapsing. All of this means that we're in a market where the next few data points could tip the balance, up or down. So what do you do with all of this? First, you don't bank on a September rate cut giving you a huge mortgage rate drop. As I mentioned, the drop in rates are already going to be baked in. Second, watch the trends, labor market and inflation together. That's what actually moves the 10-year Treasury and therefore mortgage rates. Third, the right time to buy is when your finances, your job stability, and your personal goals line up. Not just when the Fed says cut. This isn't about timing the market perfectly. It's about making your best move with the information that you have at the time. In fact, Fannie Mae just put out a home buyer survey that showed buyer sentiment is up 2%. As buyers believe home prices will be higher and rates will be lower in the next 12 months. So as we get closer to 6%, economists believe that we could see as many as 500,000 more in existing home sales. This increased demand will return some of the power back to sellers and dissipate the negotiating power that buyers have today. The economic reports, the swift changes in political moves, and the temperament of investor pool will keep shifting. My job is to break it down so you understand not just the impact of all of this is having on rates and affordability, but ultimately why. So if you want to stay ahead of the noise and you want to make smart decisions for your future, stick with me here every single week because clarity beats panic every time. This is Nicole Ruth. I'll see you next week.